Have you ever wondered where money comes from? Not just the coins and bills in your pocket, but the whole system that keeps our economy running. At the heart of it all is a powerful institution, the central bank. Today we're going on a journey through time to uncover the fascinating history of central banks, from their humble beginnings to the global powerhouses they are today. Let's rewind the clock to the 17th century. Imagine a world of merchants, trade, and a chaotic mix of private currencies. It was a messy time. In 1668, Sweden stepped up and created the world's first central bank, the Sveriges Riksbank. Its initial job was pretty straightforward: manage the national debt and provide a stable currency. This was a revolutionary idea. Just a few decades later, in 1694, the Bank of England was established. Its mission was to finance the government's war efforts against France. It started lending money to the government, and in return it got the exclusive right to issue banknotes. This set a powerful precedent, linking national finance with a single authoritative banking institution. These early central banks were pioneers, but they were very different from the ones we know today. They were often private entities, working closely with their governments but still driven by profit. Their main roles were to act as the government's banker and to issue a reliable form of paper money. The idea of them managing the entire economy, fighting inflation, or preventing financial crises, that was still centuries away. The American experiment with central banking was a bit of a roller coaster. He believed a central bank was crucial for a stable and prosperous nation, but others, like Thomas Jefferson, were deeply suspicious. They feared it would give too much power to the federal government and a wealthy elite. This debate raged on, and the bank's charter wasn't renewed. The same fate befell the Second Bank of the United States. For much of the 19th century, the U.S. operated without a central bank, a period known as the free banking era. It was a time of frequent financial panics and instability. Thousands of different banks issued their own notes, creating a confusing and often unreliable money supply. Imagine traveling from one state to another and having to figure out if your money was even accepted. A series of devastating financial panics, especially the Panic of 1907, made it painfully clear that the system was broken. The U.S. economy was grinding to a halt because of bank runs and a lack of liquidity. The public and politicians finally agreed that something had to be done. After intense debate and political maneuvering, the Federal Reserve Act was passed in 1913. This created the Federal Reserve System, or the Fed as we know it. Unlike its European counterparts, the Fed was designed with a decentralized structure. A central board in Washington, D.C. and 12 regional reserve banks spread across the country. This was a compromise to balance federal power with regional interests. Its initial mandate was to provide an elastic currency, meaning it could expand or shrink the money supply to meet the economy's needs, and act as a lender of last resort to prevent bank failures. The 20th century threw some major challenges at these newly empowered central banks. First came the Great Depression. This was a defining moment. Many economists, like Milton Friedman, later argued that the Fed's failure to prevent widespread bank collapses and a massive contraction of the money supply made the Depression much, much worse. It was a harsh lesson. Central banks learned they couldn't just be passive observers, they had to be active managers of the economy. Then came the post-World War II era. Under the Bretton Woods system, the US dollar was pegged to gold, and other currencies were pegged to the dollar. Central banks around the world worked to maintain these fixed exchange rates, but this system came under strain in the 1960s and early 1970s. The US was printing a lot of money to finance the Vietnam War and social programs, leading to high inflation. In 1971, President Nixon famously closed the gold window, ending the direct convertibility of the dollar to gold. The Bretton Woods system collapsed, and the world moved to a system of floating exchange rates, which is largely what we have today. This new era brought a new enemy, stagflation. That's the nasty combination of stagnant economic growth and high inflation that plagued the 1970s. People were losing faith in the ability of governments and central banks to manage the economy. In response, central banks began to pivot. They started focusing on a new primary goal: price stability. The idea was that by controlling inflation, you create a stable foundation for sustainable economic growth. This shift was famously led by figures like Paul Volcker at the Fed, who dramatically raised interest rates in the early 1980s to break the back of inflation. It was a painful process that caused a deep recession, but it worked. Inflation came down, and it has largely stayed down in most developed countries for decades. This new focus on fighting inflation led to another major development: central bank independence. Politicians often face pressure to boost the economy in the short term, especially before an election, even if it leads to higher inflation later. By making central banks independent from direct political control, they could make tough long-term decisions without worrying about the political calendar. This became the new global standard. From the European Central Bank, established in 1998 to manage the euro, to the Bank of Japan, central banks around the world were granted more and more autonomy. Their main tool became the short-term interest rate. By raising rates, they could cool down an overheating economy and curb inflation. By lowering rates, they could stimulate borrowing and spending to fight off a recession. This model worked pretty well for a while. But then came the 2008 global financial crisis. This was the biggest test for central banks since the Great Depression. Lehman Brothers collapsed, and the global financial system was on the brink of a total meltdown. Simply cutting interest rates wasn't enough. Many central banks had already cut rates to near zero, and they were still facing a collapsing economy. They had to get creative. This is when we started hearing about unconventional monetary policy. Central banks, led by the Fed, rolled out massive programs of quantitative easing, or QE. This involved creating new digital money to buy huge amounts of government bonds and other assets. The goal was to pump liquidity directly into the financial system, push down long-term interest rates, and restore confidence. They also started using forward guidance, which is basically telling everyone what they plan to do with interest rates in the future to manage expectations. It was a massive, unprecedented experiment. Did it work? The consensus is that it helped prevent a complete economic catastrophe, but the long-term consequences are still being debated. These actions massively expanded the balance sheets of central banks, and we're still navigating the process of unwinding them, and that brings us to today. The role of the central bank has never been more complex. They're still focused on price stability and employment, but now they're also grappling with financial stability, climate change, digital currencies, and the fallout from a global pandemic. The COVID-19 crisis prompted another massive wave of central bank intervention, even larger than in 2008, to keep economies afloat during lockdowns. The history of central banking is a story of evolution, from simple government bankers to powerful managers of the global economy. These institutions have constantly adapted to new challenges. They've made mistakes, learned hard lessons, and invented new tools along the way. They operate in a world of uncertainty, trying to navigate the complex currents of the economy. The debates that started with Hamilton and Jefferson about power, control, and the proper role of a central bank are still very much alive today. As our world continues to change, one thing is certain: the story of the central bank is far from over. Thanks so much for watching. What do you think the future holds for central banks? Let me know in the comments below. And if you found this journey through history interesting, don't forget to like this video and subscribe for more deep dives into the world of economics and finance. See you next time.